They're like, if you bring the costs of purchasing a home down, referring to the fees, then there'll be more inventory and people will do it more often. I'm like, it doesn't make any sense because we have...
Name the bar that they came out of. We are not a country of deflationary economics.
You talk about it privately, we talk about it publicly. This is the Real Estate Insiders Unfiltered podcast. Welcome again to the Real Estate Insiders Unfiltered podcast. I'm your host, Dwiggy Dwiggins, along with Crazy Uncle Robinson. We had a good one today. We had Logan Mohtashami, the lead analyst for HousingWire, which you all have seen on pretty much every news outlet humanly possible. Keith, you nerded out. Talk to us.
Yeah, that's the most important part. I went full fanboy on this one. I've been following Logan for a long time. This is I'll probably text my mom later. That's how big a deal it was for me to have him on the podcast. He talked about the tragic accident that has been his career in analytics, which I loved. We talk, of course, recession, interest rates, affordability, how he would solve affordability. He's just got such a great mind.
Smart.
Yeah, wicked smart. Talks about it in a thoughtful and approachable way. It was a real honor to have him on the podcast and have him share his brain with us for 45 minutes. It's a great session. You are going to dig it, kids. Put it in your ear.
Logan, welcome to the show. We are excited to have you here whenever there is another
I'm excited.
economic I'm gonna say it, economic nerd. Then you guys are great because Keith, I get to feel like I can say that because Keith is, and he's been very excited to have you on.
Yes. I'm having a total fanboy moment. Followed Logan
totally true, by the way,
for years. So I don't know.
I'm not that young anymore. I was looking at my first video on CNBC like in 2014, and I was like, "Oh my God, who's that kid?
Yeah,
it's all dark hair, no beard.
Real estate does that to you.
I don't recognize that kid."
Keith had hair like 6 months ago.
Yeah,
and
you're not allowed to complain about your hair, sir. It is far too glorious.
And speaking
especially
of,
when compared to mine.
Speaking of, there's a similarity here between you and Jack Nicholson on your over your right shoulder there. So obviously a fan.
Trying to like get the kind of.
Yes.
Yes.
Maybe pull a little Hannibal Smith, 11 together.
We just had an A-team.
80s nostalgia going here for Gen Xers and Boomers.
Oh my God. Yes.
They have no idea what you're talking about.
I do. I know exactly what he's talking about.
Yeah.
I have the action figures. Yeah. Anyway.
All right. Well, look, we got a lot to talk about. And I figure for people who don't know you, which would be surprising, but if they don't, you've been in the space since like 1996. So just give everybody a quick speed round, just your background, how you got into the mortgage finance space, real estate in general, and then where you are today. And then we'll dive into some personal quick questions we call rapid fire, and then the meat of the subject, which would be the nothing going on in residential real estate market. So
this was all like a tragic accident. I was going to be a high school basketball coach and teach history. And in 1996, our family's been in banking since the late 1950s. My father opened up his own mortgage company in 1987. So in 1996, I started helping out with the business. I got into the stock market. And then I saw the first year contract of being a high school basketball coach and teacher. It was like $26,000. And I was like, oh, okay, no. So quit that in 1999, started to work full-time as a loan officer in, I think, 2003. In 2010, a man named Jason Resnick from Benzinga asked me if I wanted to write about political economics. I'm like, hell no, I hate politics, but I could write about real estate. And that is how today started. There was no intention of me of doing any of this stuff. I opened up my own blog. My work started to get a little bit popular nationally. I've done some media outlets in the early part of the last decade. And then I saw that there's so much bad information out there on the internet that I thought to myself, you know what? I'm going to do it differently. And by 2015, I decided to just talk like how an analyst would talk or an economist would talk. And I molded everything into a chart database system and just to talk about economics in a more efficient way. And then in 2019, Clayton and them asked if I wanted to write. I said, at first I was really hesitant, but a lot of people in the mortgage industry said we would love that. So joined HousingWire the last 2 weeks of the year. And then COVID happened, right? And then I was like, okay, so for people that might not be familiar, I've been talking about years 2020 to 2024 for like 10 years before this period. This was like the period in time where demographics are going to be really good. So then I'm starting to think, okay, I have to write a COVID-19 recovery model when I think it's the right time. So April 7th, 2020, wrote a recovery model. Went to HousingWire and said, hey, listen, let's publish this. We're going to recover this year. They thought, oh my God, he's crazy. We can't do this. So thankfully they did, and everything kind of worked out. Bork got very popular. Made it a big thing for me to go after the housing crash people and the doomers and gloomers. So I'm just basically an economic nerd who by accident decided to write and retired from the mortgage industry early 2020. And now I'm just chart 24/7. That's how I got here.
Yeah. You have a relentless energy for combating the, what you believe in. Usually I agree with you, false narratives around residential real estate, right? People getting clicks, or I don't know why they do it, right? But it makes you more popular if you say the world's going to end.
Yeah, it's an effective business model, but I've done this for so long that I've kept every single year since 2012. I actually kept every reason that was supposed to have home prices crashes. So I said, we're going to have a broken clock theory. At some point, it's going to be 12 years and they're going to be wrong. And that was last year. Right. And then all of a sudden they kept talking for 2024. So I thought the best way to do it is to challenge these people in live debates and get their forecasts, because I don't think 90% of them are serious. They're just do it just to get clicks and revenues. But this way it became a very effective way to get people to debate me live. And once I get them on a debate, they're cooked.
Yeah, people have taken you up on that? I haven't.
A few of them have, and it hasn't ended well for any of them. You could just see that they're not housing people. They have no working models. You ask them for the forecast and they're like, no. So, so I kind of made a name just for doing that, but still keeping into the kind of the economic cycle forecasting mode 24/7.
Well, we'll get into a lot of that. I want to ask just a couple quick rapid fires. We do this with all of our guests. And so just first, we'll kick it off with tell us and the viewers and listeners your favorite book or podcast this year, last year, doesn't really matter, but just like, what are you listening to, or what book you're like, this is the book to read?
HousingWire Daily, because I don't listen or watch any podcast or read kind of any books. I literally spend my whole day watching live data, whether it's commodities, bond market, currencies, and taking in every single economic report. So I actually don't watch TV. It's funny because people see me on CNBC a lot and go, the only time I ever watch CNBC is when I'm done with my interview. I'll go out to the living room and see myself for about 10 seconds.
Yeah, that's it.
Those are your 10 seconds. Yeah, I literally I don't follow a lot of people or anything. I just focus on the data, and I try to do that because I want to take the human emotion out of my work, which is good. For me, it's kind of, and this way my focus is directly onto the data and not anybody's ideological takes or anything like that. So
what an interesting way to approach the world, to use data and not opinion to form your own opinion.
Yes,
who knew you could still do that? Who knew
it makes you a pilgrim in an unholy land, though,
Well, I got your back. If anyone's got a problem with you, they got a problem with me. Follow-up question then. If you could have lunch with one person, current or historical, who would it be and why?
It would have to be Genghis Khan. Because
by the way, you guys just had a bro moment, and I will now turn it back over to Keith. Keith, go ahead.
Literally half the way through the biography of Genghis Khan and sort of how he came to power and what he did that was different.
I was actually a history major. I was going to teach history. So there's a lot of people that I would love just to have a sit and chat, but the Mongols were it. I mean, they just dominated the world, and in a way that we'll never ever see it replicated. Unless an alien force comes in and takes us all over. So it would be interesting to see the mindset of the stages, and how that went about. I mean, some people would say that 25% of the population in Europe is, has some Mongol, has his blood in it, So it's just what they were able to do for so long is to me, it was like a historical freak of nature. So I kind of want to see the mindset about him through his stages.
It's a good one. We've had a lot of, we asked this question to everybody, and the answers are all over the place. And as you can imagine, from God to my mom or my dad, but that's Genghis Khan's you're the first person to say that, so that's good.
I literally told James a couple days ago that I was reading the not the autobiography, but the biography of Genghis Khan, and he looked at me like I had 47 heads. It was awesome. So to hear you say that is
he was like, have you do anything about it? I was like, other than he populated like half the planet, but yes. So all right. Well, look, we've got you here. You study this stuff more than anybody that we know. So let's dive into some of the questions when everybody's obviously very front and center right now. So let's start with the economy. We had some jobs numbers came out that, depending upon what side of the fence you're on, were good or bad. You think we're headed into recession? And then a follow up with that, 'cause it's probably obviously tied, thoughts on a rate cut in September with the feds.
And then rates in general, regardless of rate cut.
Yeah.
So a 3-part question.
So I have my own kind of recession model. It's like a 6 recession red flag model. It's funny because I actually presented to the conference board. They're the ones who created the IMF, World Bank. And I used one of their data line sets as my models. And what traditionally happens at this stage of the cycle is that residential construction workers tend to lose their jobs, and so does manufacturing before every single recession. So kind of all my flags are up except actually housing. And I'm just looking at that data line set because especially right now where the labor market is, if that occurs, the unemployment rate is going to go north of 5% and you're going to have job losses. So that's been every single economic cycle post World War II. So I do what I call as a progression model. I always tell people, if I ever say 40% chance for a recession, everyone block me, shoot me, just throw me in the water, whatever. We don't do percentages. We do forecasting models. So we can talk about stages so we don't get caught with a bad recession call. We have to double or triple down on it. So at this stage, we're just keeping an eye on residential construction workers, which is 5-unit apartments, remodeling jobs, and single-family jobs. If those tend to fall and manufacturing tends to fall, there's your start of every recession. So we're at that stage of the cycle where the Fed, on purpose, which is kind of my thing, went to attack the labor market more than inflation. The growth rate of inflation was going to fall regardless, just because of the supply chains getting better. But they ran a kind of an old Fed model about being very restrictive until the labor market breaks. So that's kind of been my thing since the end of 2022. People that follow our podcast know this all the time. Yeah. They're getting to the point where I call it cover. They say the word confidence. They need confidence. No, they need cover for their rate cut cycle because they're not 100% sure of anything. But if the labor market starts to break, then they go, hey, listen, we got to cut rates. The labor market, that's our dual mandate. So a lot of people have been surprised. Why haven't they cut earlier? The growth rate of inflation has fallen so much. But to me, it was always about the labor market, attacking the labor market first. And then when it breaks, they can do anything they want or how they feel to help the economy at that point.
It's hard for the Fed to get on a microphone and say, I want people to lose their jobs.
Yeah.
Right? Like that's not an easy thing for them to say. But the reality is, to your point, they could have started cuts earlier if it was just data dependent or inflation dependent, right?
If they were honest, they would have cut 3 to 5 times already and still be restrictive based on their model. But when they start doing certain terminologies that were like we're not accustomed to, I thought, okay, they really need, there's like a whole series of labor data lines that I track. And I said, they need wage growth to get down to 3%. They need job openings to 7 million. They need the unemployment rate to rise. So these things are happening. They're now at a point that kind of 1 or 2 hiccups and it's a hard landing. So to me, this is all by design. And they've stuck to it for 2 years. It's been hard trying to convince people the last 2 years, but this is it. But now that everyone sees, like we have 9% CPI inflation down to 3%, 7% PC inflation down to 2.5%, no cuts. And even if they would have cut a few times, they're still restrictive on their model. So they're doing exactly what I thought they would do, but they're really playing with fire at this point, because even if they cut a few times, they're just like moving to maybe we get to neutral, not an accommodative stance. So when the labor market breaks, they're going to go, we didn't see it coming. Now we have to be more aggressive. And then they have cover for whatever they do over the next 2 years.
Yeah, some would say that the Fed, and they've been this way, in my opinion, I love your thoughts, but they've been this way from the beginning. Some would say asleep at the wheel, or, some would say patient or over patient. I'm more in the asleep at the wheel camp. Like, they just are slow to take action. They were slow to start raising. Then when they did, they started ripping them, and they seem to be over slow in cutting them. And maybe the same thing will happen. Who knows?
I think people that listen to our podcast know the term I use. They're old and slow. That's just who they are. It's the nature of the beast. We could go back decades. That's just
old and slow. We're talking about the Fed, not people running for president,
members.
right? Or
there's a lot of people that would fit into
Sorry,
that
I thought
category.
we were having a conversation about all politicians for a second. There was weird.
Logan's on record. He doesn't like politics.
That's true. Yeah.
So you think that
politics is the word itself? Politics, many blood-sucking parasites. So that's kind of how I look at it.
So you think rate cut in September?
Rate cuts in September, and the worse the labor market gets, the more aggressive. But for everyone in real estate and mortgage, the rate cut isn't the story. If the labor market starts to break, the 10-year yield will start to go lower. If you get more rate cuts, then the spreads should get better. So if we had normal spreads, what we've seen, going back to the early 1970s, mortgage rates are 5.5% today, without the 10-year yield falling.
Just in case someone doesn't know, that spread means
the difference between the 30-year fixed mortgage and the 10-year yield. And whenever there's stress or a recession in the economy, the spreads get bad and then they get better in time. And this has happened in many economic cycles. They're not 100% an exact science, but the spreads have been very elevated for a long time here. They were getting better in 2023, but then the Silicon Valley banking crisis happened and they got worse again. They even got pre-cycle highs worse. So the only reason we got 8% last year in mortgage rates is because the spreads were really bad. But now the spreads are getting better. Like, a good example is that if I took the worst levels of 2023 and incorporated them today, mortgage rates are 0.5% higher, but they're not. And if the spreads have so much leeway to go lower that you can make a sub 5% mortgage market forecast if you get normal spreads and the 10-year yield just going down just 25 to 45 basis points from where it is right now. There it is. There's your sub 5%. But that's, again, we're not at that stage yet. We could start to move to that area, and it really depends on the labor market. My thing is like paper, rock, scissors, labor over inflation. People have been overweighting the inflation data, thinking that rates were going to fall 1-to-1. That wasn't the case. But now that the labor market is getting softer, the 10-year yield has tried to get ahead of the Fed twice. It hasn't worked out because the labor market wasn't breaking. But this year, we're starting to get deterioration in multiple labor data lines that the Fed tracks. And the bond market is just reacting kind of to that at this point.
So rates will have downward pressure with or without a Fed cut. When and if the Fed does cut, that only theoretically, depending on what they do, should help that and give that even a little more emphasis for downward pressure.
And we've had two other times now. This is the third time that mortgage rates have kind of fallen, kind of like 1%, maybe from the internal peaks. But in this case, the other two times the labor market wasn't breaking. This time, it makes sense. So early in the year, I talked about now I could finally feel a little bit more confident because the labor data that the Fed told us to track are deteriorating right in front of them. And they're kind of like, well, this is kind of what we thought would happen. And once they break, boy, that 10-year yield is just going to sink. Then if the spreads get better, you put them together. There's your kind of sub 6% mortgage rates, and if we go lower in the 10-year yield, you could get sub 5% mortgage rates.
So two things I heard you say. I just want to be clear on that: soft landing or hard landing. You mentioned hard landing potential, unless I misinterpreted what you said. So
to me, if we're losing jobs and the unemployment rate is above 4.6%, that's a hard landing. Okay. That's been what always happens because the Fed is late to the game. So that I'm just going with the history of them trying to get this. And if they would have started earlier, I could be a little bit more positive on that. But they're waiting on purpose to. It's like they sit here and like, okay, now the labor market's breaking. They even kind of make comments about this. We kept rates high because the labor market isn't breaking, but when it breaks, okay, then we'll be, well, it's like you're not supposed to wait until that happens. You're supposed to get ahead of the curve. And,
Just to try to put a descriptor on hard landing, are you saying 2008 hard landing, or are you saying?
No, the demographic backdrop of our labor market is much different now than 2008. Here's a good example. Job openings in 2008 was 2 million. Job openings today is 8 million. The baby boomers are leaving the workforce. They need to be replaced. So the labor dynamics are different. Also, we had a massive credit boom and bust that had to be deleveraged. We don't have that now. So we're not going to have a 2008. I would say if I had to pick a cycle, it's more or less about, after the tech boom and bust.
Early 2000s.
Where
Recession.
we have a higher unemployment rate, we lose millions of jobs, but in scale terms, it's not a very big drastic because household balance sheets are so much different. Also, society is like, everybody saw what happened during COVID, what they can do to make sure the economy runs fast. So the days of not helping out in a more aggressive fashion like we did after 2008, those days are over with. Politicians can't risk it, and the markets are like, hey, listen, we can do things to plug holes. I just believe that the Fed needs the labor market to break to start getting into that mindset. We're not there. We're getting there, but
you think one more jobs report?
It's all their plan. And to me, they've executed their plan to the best of their ability.
One follow up on this, just because we'll kind of put a bow on it. You think rates your opinion on rates, where do rates need to be for the housing market to move back to a more normalized market?
So this is a very detailed talk about me. I've always been in the camp that I've only seen the housing market grow sales in the new home sales market. And that's a sub 6% mortgage market world. Every single housing cycle, new housing cycle going back from 1981 has needed 2% plus lower rates and staying there to grow kind of sales. So we've had 7 to 8% is the kind of the high point. To make it simpler, 4 to 6% mortgage rates, they have to stick there for years. If they stick there for years, you can grow your sales back. We have these periods where rates head down. We get like 8 to 12 weeks of positive purchase application day, and then rates shoot up because it's still elevated in relationship to what is needed for demand to grow. So you get the next economic cycle going, and if mortgage rates can stay between 4 to 6%, then you can grow sales and have it stick. But if we're 6, we have rates go from 7.5 to 6.5 and then back up to 7. That's not going to work. We've seen this is the third calendar year of the lowest home sales ever recorded in history. We have over 162 million people working. So there's so much demand waiting, but they do need that kind of that 4 to 6% range. And that goes with every cycle that we have seen. That's kind of how I look at it. And when CNBC asked me this question earlier in the year, I kind of said, well, if you want to grow sales and have it stick, you need about kind of 4.75 to 5.875, and then keep it there for a while, and you could grow sales. But an easier way to look at it is between 4 to 6%. And this kind of reminds me of the late 1970s and early 1980s when affordability was worse back then. Rates were much higher. Inventory was much higher. Home prices didn't fall at all during that period of time, but rates had to really go lower to get sales to grow. And we had a similar kind of backdrop where back then home sales went from 2 million to 4 million. And then, when rates got up so high, we went from 4 million down to 2 million, very low levels of sales. But over time, as rates fell, demand grew. So we need something like that for this to work.
I want to add one thing on the rate discussion, just because I think sometimes we, especially economic nerds, self-proclaimed like Logan and myself, we're into the interest rates. It's because it drives the market. It's important. What I worry about actually is because most residential real estate professionals kind of don't care, right? Whether or not they should, we could debate, but they're brilliant service people. I worry that we're going to start to get whether we call it, we get a better rate environment, regardless of how and why, at peak distraction time. The industry is going to take their eye off the ball of serving the consumer at a very high level, because they're distracted with changes to how they're doing the paperwork and the settlement.
It's happening
lawsuit.
right now.
Because then it's October, and then next thing you know, it's Thanksgiving and Christmas, which usually is a slower time of year. Like, I think there's a window between, call it right now, and Halloween, where you can make your 2024 and set up your 2025. And that is at a peak time where the industry has got the eye on other things as opposed to fundamentally operating their business in an improving rate environment.
The problem with, let's say, if rates fell, do we have enough people working in the industry to fulfill the demand?
Mm-hmm.
Yeah, because I mean, as a former LO, whenever rates had fallen, like in 2012 to 2013 or 2016.
Just to be clear, you mean on the mortgage side? Just to be clear on the statement.
Yeah, just on the mortgage side.
Okay. I was like, there's plenty of realtors. So like,
yeah,
I was like, you meant on the mortgage side, just for clarity, underwriters, processors, everybody to be able to handle the volume. Yeah. Okay.
Because all of a sudden you got a little bit of growth in purchase, but all of a sudden you got a big rate and term refinance, and the processing times get to be really stressed out. And doing this for so long, I remember those times because everyone's kind of to the skeleton crew already. And then if it happens like this, they're like, whoa, now turn times are great because, demand. But if something happened, the capacity for the mortgage industry, can they do it now? So you don't have like, it's 45 to 75 days.
Yeah. Because you spend 2 years reducing staff.
Yeah. And we're so used to just quick, product. I remember there was something called a fax machine back, 15 to 20 years ago, and a Transbox.
There's a real estate company named after it.
Yeah. And it was just like, it took a while to get things done, but now productivity has made things so fast that it doesn't, we don't need, but that's a more properly staffed group. Yeah. So that is one thing that I'm keeping in mind now when it does happen. I mean, to be honest, it's somewhat of a first world problem at this stage. If something like that happens.
Yeah, like that. I would take that problem.
You want that problem, but that is something
we have a mortgage company, so Keith and I know this well. We're like, please give us that problem.
I'd much rather have that problem than the current problem. All right,
let's shift the gears on this a little bit just because of time's sake. There's a lot of stuff I want to ask you. Just quick thoughts on the NAR settlement, potential outcomes, mortgage and financing perspective. Like, we've heard everybody's opinion on the realtor side. I want mortgage financing side opinion on this.
So I would address it on the economic side. I don't think people thought this one through because I've always looked at it as that the housing market, because it has trillions and trillions of dollars of wealth, it was always a quiet stimulus program for buyers, especially first-time home buyers, that the selling equity made housing less expensive for home buyers and first-time home because the buyer's agents would get paid. Now, everything is up in the air, right? You just don't know. So if you're asking people to bring in more money, that's a net effective housing inflation story. Now, I would say you would need at least 12 to 18 months to kind of look at the data to see that is something worked out right. But my first thought and big thought is that we went from a stimulative program using whatever $52 trillion of financial assets in housing to now we're asking people to bring in money. And now there's also confusion about it. And that to me wasn't supposed to be what it was about. And the fact that nobody knows, it didn't seem like the most efficient way to do this. And the more I hear from the Department of Justice and attorneys, I could see what's happened. You don't have the experience in the people making the rules or changing the rules. And because of that, to them, they don't understand how the system works, and that's just going to take some time to kind of move through itself.
When at a time when it's one of the worst affordability markets ever, right? Anyway, it's the last thing we need is more affordability headwinds for especially the first-time home buyer category, right? If you're doing a trade up, trade down, empty nest, you have liquidity because you have equity. But if you're a first-time home buyer, it's tougher.
I always say that housing economics, a lot of times we don't think about it this way. 70 to 80% of sellers are buyers. So a seller is going to at first people thought, they're going to cut prices because these sellers are going to say, we don't need. I was like, what angel seller have you ever met that's going to go,
Oh,
we're going to cut prices because we don't have to pay. No,
yeah, it's so stupid when people say that. I just look at them. I'm like, what planet are you on?
It has never worked that way. And I'm like,
my first question when someone says that is I just ask them, oh, really? So you would do that? So you would take less money for your home? And the answer is always no. Right?
No.
Right.
Everyone's going to do it. But the seller then who thinks, okay, I get to keep the money, then that seller becomes on the buyer side of the equation.
Right. Where they got to spend the money.
It's like, not the most effective way to do it. But again, this is what we are. So I think if you're a seller that's keeping the money and then you're renting, you sell your home and you rent, okay, you can make a very positive case in that. But since most sellers are buyers, they're going to go on the other side of that anyway. But the first-time home buyer, which finances 90% plus of their home buying, it just makes it a little bit more confusing, a little bit more expensive. So we'll see how that goes. But it is interesting that I kind of look at it that way, and I still to this day nobody's ever given me a really good explanation on that being ever discussed.
It's because the lawyers did it for the money. They didn't give a shit about anything other than the 30% that they got off the judgment.
Here we go.
No, I'm like, look, come on. Like, we can all admit what went on here. So, I guess I have a question then. We've had a lot of guests on our podcast recently, and we had Shannon McGann, the Chief Advocacy Officer for NAR, on, and we asked her the question about, how do we make it available for buyers to be able to afford representation that they want versus, I love this analogy, having to use the public defender. So, she was like, good luck getting Fannie and Freddie to make any changes because Congress, it needs to be important and a priority for them. Like, what's your take on that? Do you think there's going to be any mechanisms for the ability for a buyer to be able to have a way for them to afford and pay for representation if the seller doesn't want to pay it?
I would say you would need probably maybe 4 to 5 months of it showing that it's not a very positive trend.
Right.
And then all of a sudden politicians don't care until it actually affects them possibly in the voting.
Yeah.
And the reality is homeowners vote more than renters.
Mm-hmm.
So it's one of these things that if there's enough outcry, and trust me, this is what we do in this country. When we want to outcry, we outcry. Mm-hmm. And if it gets out there, then all of a sudden the politicians go, okay, let's figure something out here. This is not working. And that's been how things have gotten fixed over time. There's enough carnage out there or screaming out there that eventually somebody gets a plan together to make it more efficient. But that first wave is always going to be ugly.
Yeah. All right, I've got one that's adjacent to what we've been talking about. Sometimes I find myself screaming into the social media void about affordability and falls on deaf ears most of the time, probably because it's too complicated a problem to really try to solve on social media. But if you were the real estate czar and you had total control over how to change things to drive affordability, what would you do to help make housing more affordable? How would you work to solve this problem?
So the term I've always used is that the best way to deal with inflation is supply. Mm-hmm. Demand destruction has been done at times, but it's a very short-term fix, and it eventually does too much that the future production of supply has been hit. We see this now. Multifamily permits are at recession lows currently. I would just unload the God's hell warriors to build as much housing
just swing hammers as fast as possible.
I mean, it would just it's been a big part of my work over the last 14 years. How we're not going to have like a construction boom. Everybody keeps on saying we're going to have it. The builders only build off of their own demand curve. They're here to make money. The existing home sales market is their main competition, right? So if there's more supply there, the builders go and they can't sell their homes. They're going to pull back, and we've seen it now. Housing starts are pulling back toward COVID-19 recession low levels. I would just focus on trying to build as much possible, because if you defeat inflation by more supply, especially with rents, then rates can go lower. And that supply in itself becomes something better for rates. You put them together, your house becomes more affordable. I mean, if mortgage rates, we woke up tomorrow morning, we're at 4%. it's more affordable for home buyers because the cost of shelter has gone down enough. But if you're talking about longer term, you just have to build out there, and it takes forever. Unfortunately, construction productivity has been the worst for like 8, 9, 10 decades. I mean, we built homes with hammers and nails in the 50s, and we still do that to a degree.
No
so other sectors of our economy have a lot of productivity. Here we don't. So that's the only thing I've ever talked about, is that you can't deal with some of the other things. But unfortunately, we finally paid the piper. Like, inventory had been falling for many, many years, and nobody like paid attention to it because everybody talks about home prices are going to crash, inventory is going to, but there's a model for this. Like after qualified mortgage came in, most sellers are buyers, right? So that inventory is a wash, but the 20 to 30% of inventory that's left over, guess what? The first time home buyers, they don't give you a house. So you could see how inventory gets lower and lower and lower, because millennials started buying homes in 2013. They were the biggest home buyers for many, many years. They lost their title when mortgage rates went up higher, but then they've regained it back. So here, I always tell people, at every conference I speak in, I go, does anybody know how low inventory was in March of 2022? And nobody knows. And I go, it was 240,000 single family homes available for sale. In a country of 336 million, over 158 million people working, guess what? Too many people chasing too few homes. So we finally paid the piper, right? Where the supply was actually the story. And we just had multiple bids. I think so. It's 78% of homes in America had multiple bids that month. So we've done the demand destruction, but we still have to focus on just building. And that building, in a sense, is disinflationary because rents will go down, and that'll help the affordability with rates as well.
So let me ask you a follow-up on that, because I hear people say this all the time, and maybe I'm looking at it wrong, but it just doesn't compute to me. They're like, if you bring the costs of purchasing a home down, referring to the fees, then there'll be more inventory and people will do it more often. I'm like, it doesn't make any sense, because we have certain amount of supply.
Bar that they came out of.
But
name the bar that they came out of, and then I'll give you. I mean, no, that's not how it works. Deflation is not something. We can start with the administration,
by the way, just for clarity. The current administration is saying that.
It doesn't. We are not a country of deflationary economics. Post World War II, deflation is very rare, right? The costs are always rising in an economy that can grow, but if you really wanted to attack housing affordability, you have to build, because once that home is there, that's a supply. There. People can live in it, right? Everything else is Mickey Mouse, right? But that home does not go away. People live and die, but if their homes stay the same, so eventually when somebody dies, they leave their home off. So that supply is solid. There's always 200,000 to 300,000 homes that have to be demolished and rebuilt, but supply has always been the best way to deal with this. And the previous cycle, we had the weakest kind of housing recovery. We had the weakest construction recovery. And even right now, housing starts are kind of going to COVID-19 recession lows. So
the builders,
we don't have the right mechanism in place here. And I've always believed this. We've never had it in place to really deal with this issue. And we finally paid the piper with it.
I agree with your solution. I just don't see it manifesting, because in 2008, the builders, for the first time, at least since I've been paying attention, they got religion on this whole, we're a boom bust business and we're fine with that. And we'll ride out the bus and we'll print money in the boom. And we know there's risk involved. Then they got their heads caved in 2008. And ever since then, they've had a risk off approach into like, hey, we can control some of this inventory stuff. You see that changing?
Here's the thing. This is where my work is very different than any other housing economist. I actually don't believe the builders underbuilt in the last decade, and I'll explain why. The new home sales sector had the weakest recovery ever. They missed sales estimates in 2013, 14, and 15, and in 2018 they had a supply shock. What had happened was the active inventory was so big. The credit markets changed. The mortgage availability index really shot up and then it just collapsed. So as we were working our way, existing homes were just much cheaper and there was more supply of it. So the builders never got any traction. Now, roles reversed. Active inventory is near all-time lows.
Right.
Mortgage rates are very high. So existing home buyers have the housing inflation story where the builders are like, hey, everyone, come buy this new home and we can offer you 4.5 to 5.5% mortgage rates. So advantage, disadvantage, where they were at a disadvantage in the last cycle, they have an advantage now. And this is really the big publicly traded builders. You know, their gross profit margins are over 20%. So they can do this. The smaller builders, not so much. So it's just one of these things where the builders just don't simply put their heads down and build. Now, the housing bubble crash, new home sales were booming. Existing home sales were booming. So they were building, because sales, but that needed that credit market to keep going up and just simply can't sustain itself. Here, it's just that the builders are more efficient. I call them efficient sellers. They sell homes like a commodity. Right. It's not like, they don't care about the house. They have nobody living in the house. So they're just selling the homes to make sure they could clear as much profit as possible. So they're not going to push the lever on construction. And we see this always as permits start to slow down. But in the past decade, they just never had the new home sales growth that people had forecasted. I mean, last decade was really multiple years of missed sales estimates because housing was affordable. Back then, there was a lot of supply, rates were low. It's just that home sales never got to the levels that a lot of people thought in the previous decade. You have to work your household formation up to get housing demand up. And that it was going to take to years 2020 to 2024 to get enough people in the home buying freeze. So again, we always keep it simple. Supply is the best way. The builders are almost kind of like, how OPEC thinks. They manage as much as they can to make sure the profit margins are there. So I always say never expect the builders to like bail you out here.
Just for time's sake, because we don't have a whole lot of time left, we want to get a few in here. I'm going to combine two questions I have, and then Keith will wrap us up as well. But so the first question, which is, how do you think the mortgage industry can help realtors through all these changes? And then a follow-up to that, you can combine the two. Do you see an overlap long-term between the realtor and the loan officer? An overlap could be them doing the same thing, or there's more of a partnership. So kind of the combination of those two questions into one.
So everyone in the mortgage industry has to inform every realtor as much information as possible, because let's be honest with this. There was like 1.6 million realtors out there, 640,000 of them never do any business. And then there's like a couple 100,000 that do one. So you don't know if you're dealing with an experienced realtor or not. So just assume that they're not experienced. Give them as much information on the timeline and process and what's going on. Always don't assume that they know the rules or everything, and then adjust to when the transaction is, because it's going to get sloppy out there. I think all of us that remember TRID, TRID was the first 30 or 60 days was pretty ugly. Yeah. In terms of overlap, there could be more of maybe a cooperation agreement, but I don't think loan officers become that next stage into the front load of being the advisor or a person to list a house or go to the open houses or anything like that. I think that'll always stay separate, but maybe a more cooperative relationship going out in the future.
Do you think maybe that Keith and I have been talking about this, and I'm going to go out on my own here a little bit. I think that there's a world where the loan officer and the agent do the buyer presentations together. Mm-hmm. And the reason I say that is just from the concept of, here's what the agent does. Here's the process on financing. Here's a bunch of different ways that we could finance compensation. And like, it's more of a team approach, at least for the good agents. Am I off?
I think you would need a unanimous group, a nation kind of working together for something like that. Because if you have one realtor working with one mortgage person and then the buyer goes, well, I have this mortgage person here, it has to be something that it's unanimously put together by everyone. It can't be, oh, okay, by the way, this is my mortgage, we're going to do it this way. And the other person goes, well, this is the mortgage person I'm going to use, and they don't do it that way. Mm. So it has to be something where it's unanimously done by everyone to incorporate that and move that forward. If it's done in pieces, you're just not going to get the fluidity of something like that to work.
I do think, though, that the depth of relationship has to get amplified, meaning your offer, you might be crafting a different loan structure. It used to be your buyer tells you how much cash they have. That tells you how much they can go buy. Pretty straightforward process. They go out into the marketplace, they transact. Well, now it could vary. Your offer writing process could vary. right? There'll be times where the seller is going to contribute some or all of the buy side commission. There could be instances where the buyer needs to come up with some. So the offer writing, the level of communication now isn't just sort of pre-approved. I'll update you if rates have a big move. It's pre-approved, and every offer process could be nuanced and different. So I think that level of connectivity has to get tighter. You agree with that?
Yeah, I mean, there's more at stake here with the relationships that are going to be built over the next 5 to 10 years than it was before, just because how the process is going to work. And again, that first 12 to 18 months is going to be really key, just to get everybody kind of in touch with the changes and how the dynamics are going to shift. And I'm very sure that there's probably going to be 2 to 3 governmental changes on the rules going out for the next 2 years.
Yeah. All right. Let me end. I'll ask you the question we always end with, which is this: if you were an agent or a brokerage, what's the one thing you would implement today to help your business going into this next market cycle?
Follow HousingWire daily. Listen to Logan Mohtashami, because he provides the most updated, crazy, honest to truth data. And I could tell you this, touring the country the last 18 months and doing these live presentations, I cannot express how so many people did not know the information. And now every realtor and mortgage person, all of a sudden they have all this data and they're showing it. And then their clients feel so much better. I mean, that's the reward and gift that I get, that everyone says, oh my God, I could talk to my clients, and my clients all think this is going to happen. And I show them some data and they're like, wait a second, it's not that, is it?
You've recently moved some of your content outside the paywall, right? So it's accessible to everyone in the industry.
Just recently, so we could show people the tracker. We have a weekly tracker article that shows active listings, new listings, price cut percentages, the relationship with the 10-year yield and mortgage rates, purchase application. It's how economists would actually look at housing, but our data is fresh. Like our data is up to the week. It's not fair to have this. Like, I feel like I'm like playing God at times, but like the NAR reports and case show, these are like months behind us. Yeah. So we try to keep people, we try to like get people up to date on the weeklies. And then we show models and like what happens with things, because not a lot of people actually know this, but if you go back to 1942, it's really rare in America just to have nominal home prices decline. If you take the 2007 and 11 period out of the equation, you had 1 year in the 1990s that was flat, and then another year that was down 1%. When you show people this and you show the inventory and the credit data is what changes everyone's minds. Then people all of a sudden go, wait a second, things change when you provide unbiased context, data, and you could talk about it. And once you could talk about it and your clients, and then I always say everyone has an Uncle Dave in Thanksgiving that tells you housing's going to go down 40 to 50%. Happens everywhere. My battle's always with Uncle Dave. I want to give everybody an army of data and charts to fight every Uncle Dave on Thanksgiving, and then everybody's just a little bit more informed, and then they could make choices a little bit easier.
Logan, just so you know, just real quick, because I was laughing at. So Keith's nickname is Crazy Uncle Keith. Yeah, that's literally his nickname. Everybody knows him. Like people walk up to him, he has no idea who he is, and they're like, "Hey, what's up, Crazy Uncle Keith?" He's like, "Oh."
So because I tell them that I think housing values are going to go down by 40 or 50%. I tell them other crazy things like, whatever. I won't bore you with the crazy things.
Another pod.
We'll make sure we link to how people can get access to that data. We'll make that part of the show notes. And I couldn't agree more. You have built a machine that distills it down into, simple, bite-sized, digestible talking points for the average real estate or mortgage professional.
Black lines on charts just to make it even easier. Like, this was 2005, 6, 7, 8. And
it's great
that
content.
little tiny, everyone get your glasses out. Look there's that 700% foreclosure percentage that people talk about. It's too small. So you try to make it, if economics is done right, it's supposed to be boring. It's not really like this fun, sexy thing to do. I try to make it as entertaining as possible, so everybody could ingest the data and then they could talk about it too, and nobody has to be totally bored about it.
Well, we'll end on this. We had Skylar Olson from Zillow, the chief economist there, on our pod. Hasn't been released yet, so everybody watch for that. And I noticed something about economists. You all have something really interesting behind you so you've got Jack Nicholson. She had the library. Oh, Keith, what is it? The library card.
Dewey Decimal System.
She had the Dewey
card
Decimal
holder.
System.
Yeah.
Like the entire shelf behind her. So, Logan, awesome to have you here.
I used to have my equation board, white chalkboard, where I'd write my equations up and they would be backwards and everybody would look at it and they'd be confused. They're like, what's that variable? And then I said, okay, forget it. I'm putting Jack behind
but
there.
But it's good because your hair is similar and you could do the cigar. Yeah, there it is. There it is. We'll end on that. So, awesome. And just real quick for viewers and listeners, if you ever get a chance to hear Logan, go find him. He does a lot of speaking. He's also a very snazzy dresser. You can take a photo with him.
Listen to the pod as well. I listen to his podcast regularly. It's great.
And you'll see him on the major news outlets and things. So Logan, so much. Thanks again for being here. We really do appreciate it. And we'll have to have you back on soon. So
pleasure's all mine. Thank you so much.
Okay, you got it. Will subscribing to this podcast save the real estate industry as we know it? Yes, it absolutely will. Subscribe now and you'll be able to find out if I'm right.